Welcome to Talk Tickers. Today, we're diving deep into the Q4 2025 earnings for Home Bancorp. That's ticker HBCP.
All right, so let's get right into this one because it's a real head-scratcher. You've got Home Bancorp posting a solid beat on earnings and revenue, but then the stock just tanks. What's going on there? We're going to unpack exactly what happened. So, let's start with the headline numbers. And honestly, on the surface, everything looked fantastic. This was supposed to be another great quarter, really continuing a strong run for the bank.
They put up GAAP earnings per share of $1.46. Now, Wall Street was looking for about $1.39, so they cleared that by a solid 7 cents, a really nice beat.
And it's not just that they beat, it's how much they beat by. We're talking a full 5% ahead of what the street was expecting. That's not just a rounding error, that's a significant outperformance.
And it wasn't just on the earnings side, the top line, revenue, also came in strong. We're looking at just over $38 million, which, again, was a nice clear beat over expectations.
This really wasn't just a one-off good quarter. It was actually the capstone on a record-setting year for the bank. Think about this. Their full-year earnings for 2025 were up an incredible 29% from the year before. Just fantastic. Okay, so let's recap. You've got a clean beat on the top line, a beat on the bottom line, and you're closing out a record year. You'd think the stock would pop, right? Well, the market had other ideas.
Yeah, despite all that good news, the stock just fell off a cliff. It dropped more than 5% right after they made the announcement. Ouch.
And that right there is the big question we're tackling today. Why this huge disconnect? What did the market see or hear that completely overshadowed those great headline numbers?
Well, to get to the bottom of it, we have to look past the shiny numbers on the surface. We need to dig into the nitty-gritty of the earnings call itself, specifically, management's guidance for the future and what happened during the Q&A.
All right, so here's a key piece of the puzzle. Management came out and said they expect loan growth to pick up in 2026, targeting mid-single digits. Now, you might think, hey, more growth is good, right? And it is, but this was a big change from the slow 1 to 2% pace they'd been seeing. It's a pivot.
But the way the stock reacted tells you everything. It's like the market just collectively said, we don't buy it. Investors are clearly skeptical. They're asking, can they really hit that new growth target? And maybe even more importantly, can they keep up their profitability while they're doing it?
And a lot of that worry comes down to one key metric for any bank, the net interest margin, or NIM. You can think of it as the bank's core profit engine. And right now, investors are wondering if that really solid 4% plus NIM they've been enjoying can actually hold up if competition heats up and costs change.
So you can imagine the analysts on the call were pressing them on this. And management, for their part, really tried to calm those fears. They pointed to their low charge-offs, loans they've given up on collecting. And they basically said, look, those problem loans you're seeing, those are just one-offs. It's not a sign of a bigger economic problem.
So, where do they go from here? Well, management is basically laying out a two-pronged strategy for how they're going to get the growth engine firing again.
And it really boils down to three things they have to do. First, they've got to prove it. They need to actually deliver on that mid-single-digit loan growth they promised. Second, defend it. They have to keep that net interest margin stable, above 4%. And third, deploy it. They've got a lot of capital, and they need to put it to work with some smart acquisitions.
And they weren't shy about that M&A part either. They made it pretty clear that deal-making is a top priority now. They're on the hunt, and they're looking for deals potentially as big as $1.5 billion. That's a big move.
Okay, so let's wrap this all up. What's our final take on Home Bancorp after this call?
First things first, you have to remember the context here. This stock was on a tear coming into this earnings report. It had just crushed its peers over the last year. So what does that mean? It means expectations were sky high. The bar was already set very, very high. So when you weigh their solid track record against all this new uncertainty about the future, we're landing on a market perform rating for the stock.
And here's our thinking behind that. The market has basically put this stock in the penalty box. It's in a show-me state. A good quarter isn't enough anymore. So we expect the stock to kind of bounce around in a range, probably between $57 and $64, until there's a real reason for it to move. And the key thing to watch for next quarter, it's simple. Proof. We need to see that loan growth picking up, and we need to see that net interest margin holding steady. And as always, just a quick reminder for everyone, this is for informational purposes only. It is not financial advice